Hey everyone, welcome back to Corporate Decoder, the place where we will be digging into some interesting financial statements that might make you wonder if this company is drilling for oil or just drilling itself into a hole. Buckle up because we are diving into NextBridge Hydrocarbons Incorporated's latest quarterly report, which is basically a super detailed check up on how the company is doing financially for the period ending the 30th of June 2025. Before we get too deep, if you are new here and love understanding what these complex company reports really mean for their future, smash that subscribe button. And hey, we have a growing community on Discord where we break down more of these financial documents. The link is in the description below. This report, filed as a Form 10Q, is essentially a snapshot of the company's recent performance. Think of it like getting a report card, but for a business that deals with oil and gas. So they are telling us exactly what grubby oil and gas stuff we are going to be looking at today. It's the most recent snapshot the company is giving us. This is our company for today. They are in the business of oil and natural gas properties, which sounds exciting. But let's see what the numbers say. Now this is interesting. They are checking boxes that say they are a non-accelerated filer, a smaller reporting company, and an emerging growth company. What does this mean in plain English? It means they are not a giant established player in the market yet. They are still growing and don't have the same reporting burdens as the really big companies. This can be good for agility, but also means they might be more fragile. Okay, here is a number that tells us how many pieces of ownership are floating around for this company. Over 264 million shares. That's a lot of little slices of the company's pie. We will see how this relates to their value later. This is where the real meat and potatoes of the report are. This is all about the money. This balance sheet is like a financial MRI of the company. It shows us what the company owns, what it owes, and what is left over at a specific point in time. We are looking at the 30th of June 2025 and comparing it to the end of the previous year, the 31st of December 2024. First up, total assets. This is what the company owns. They had about $1.4 million in assets at the end of last year, and it decreased to about $1.35 million by the 30th of June 2025. That's a slight drop, not a huge deal on its own, but it's a sign they are not growing their assets rapidly. Now, let's look at what they owe. Liabilities, they owed about $53.3 million at the end of last year, and that jumped up to over $55.5 million by June. So while their assets went down a bit, their debts went up. That's generally not a good sign. And here is the kicker, the stockholders' deficit. This is what's left for the owners after all the debts are paid. And as you can see, it's a big negative number. They have a deficit of over $54 million at the end of June 2025, which is even worse than the over $51 million deficit at the end of 2024. This tells us that if the company were to sell everything it owns and pay off all its debts, the owners would still be tens of millions of dollars in the hole. This is a critical warning sign. This statement tells us how the company performed over a period of time. It is like looking at the company's income and expenses. Let us look at sales. For the 3 months ending the 30th of June 2025, sales were about $1,963. For the same period in 2024, it was $1,639. So a small increase there. For the 6 months, sales went from about $5,206 in 2024 down to $5,027 in 2025. So sales are pretty tiny and not really growing much. Now look at general and administrative expenses. These are costs like salaries, rent, and other overhead. For the 3 months ending the 30th of June 2025, these costs shot up to over $1.19 million from about $456,000 in the prior year. That is a huge jump, and for the 6 months, expenses more than doubled. From about $1.2 million to over $2.3 million. This is happening while their sales are barely budging or even declining. This is a major red flag. The company is spending a lot more money on running itself but not bringing in much more revenue. And that leads us to the net loss for the 3 months ending the 30th of June 2025. They lost over $1.2 million. That is significantly more than the loss of about $223,000 in the same period last year. And for the 6 months, the loss jumped from under $1 million to almost $2.4 million. This company is losing a lot of money, and it's losing more and more as time goes on. This statement shows the changes in the owner's stake in the company. Here is a breakdown of the stockholders' equity as of the 30th of June 2025. You can see the common stock, additional paid in capital, and then the big negative accumulated deficit. This whole section really just reinforces what we saw on the balance sheet, a substantial negative equity position. This statement tells us where the company's cash came from and where it went. it is very important to understand a company's ability to operate and grow. For the 6 months ended the 30th of June 2025, they used over $1.18 million in cash for operations. That's less than the almost $4.33 million they used in the same period last year. So they are burning through less cash in operations, which is good, but they are still burning through a lot. In investing activities, they spent about $21,000 in 2025, compared to bringing in over $1.1 million in 2024. This suggests they are not making many new investments in things like properties or equipment this year, unlike last year. And in financing activities, which is about borrowing money or selling stock, they brought in about $1 million in 2025, down from about $2.68 million in 2024. This means they are getting less new money from loans or issuing stock. When you put it all together, they ended up using more cash than they brought in, resulting in a decrease in their cash balance. Their cash balance went from about $191,000 at the start of the year down to just over $4,600 by the end of June. That's a shockingly small amount of cash for a company in the oil business. This section tells us what the company actually does. They are an energy company focused on acquiring, exploring, and developing oil and natural gas properties. They used to focus on a project called the Oro Grande project, but its leases expired. Now they have minor interests in other projects in Texas and Oklahoma and undeveloped leases in Louisiana. They also mention they have no full-time employees and use consultants, which can be a sign of a lean operation or a company struggling to make commitments. This is a really important section. It's basically the company admitting they might not be able to stay in business for much longer. They say they have not achieved profitable operations, made a big loss in the first half of the year, and have a negative working capital to the tune of over $53 million. They say their ability to keep going depends on getting new funding, like through selling more stock or getting loans. They are not sure if they can get this funding. This is a huge red flag. When a company writes this, it means investors should be very, very worried. This part just explains how they do their accounting. They use the full cost method for oil and gas properties. This means they pile up all the costs of finding and developing oil and gas, whether successful or not, into one big pot. They also have to do a ceiling test to make sure the value of their oil and gas assets on their books isn't higher than what they could realistically sell it for. If it is, they have to write down the value. Here they show their oil and natural gas properties. The numbers are pretty small. Unevaluated costs were about $590,000. They also state they had no proved reserve value as of the 30th of June, 2025. This is a significant concern. Proved reserves are the estimated quantities of oil and gas that can be recovered with reasonable certainty. If they have no proved reserves, it means they have not found anything commercially viable yet. This drastically impacts the value of their business. The table shows capitalized costs for their oil and natural gas properties. Most of it is listed as unevaluated. This means they have spent money acquiring leases and doing some exploration, but they have not yet confirmed any significant oil or gas deposits that are ready for production. They talk about their projects here, the Hazel project in the Midland Basin, wells in Oklahoma, and Louisiana projects. They mention they acquired interests in various Louisiana leases and entered into agreements to sell some of those interests. It sounds like they are actively trying to get deals done, but the money they are getting from these deals is not exactly setting the world on fire. This is always a section to pay close attention to. Related parties are people or companies connected to the company's management or major shareholders. Here they mention notes payable to Meta, their former parent, and then to Gregory McCabe, the chairman and CEO. They have significant outstanding loans from Mr. McCabe, totaling over $43 million. This raises questions about whether these loans are truly arm's length, or if they are structured to benefit the insiders. The fact that Mr. McCabe is also subordinating any debt owed to him to other loans to the company suggests a complex web of financial relationships. They detail several loans from Mr. McCabe. The combined balance of the 2021 note and loan agreement as of the 30th of June 2025 was over $21 million, with over $5.6 million in accrued interest. Then there is the December 2022 note, also to Mr. McCabe, for up to $20 million. As of the 30th of June 2025, the balance was over $22 million, with over $2.3 million in accrued interest. Combined, These related party notes are a huge chunk of the company's liabilities, approaching $44 million. They also have a note with Capco Holding Incorporated for $2 million. This note was secured by the chairman's shares and was subordinated by Mr. McCabe himself. The fact that the company is taking on debt that is secured by the CEO's personal stock is a bit unusual and might indicate financial distress. This is where they list any potential future problems, like lawsuits. They mention a securities class action lawsuit questioning statements made during their spin-off. While they mention the case was dismissed with prejudice, the plaintiffs are appealing. They also had a stockholder derivative petition that was voluntarily dismissed. These legal battles, even if they result in dismissals, can be costly and time-consuming. This section is another look at the ownership structure. They mention stock options outstanding with an exercise price of $1.2056 and an expiration in 2033. Given the company's current financial situation, it's unlikely these options are in the money, meaning the stock price would need to rise significantly for them to be valuable. They have a significant deferred tax asset related to net operating loss carryforwards of over $118 million. However, they have a 100% valuation allowance against this asset. This means they do not believe they will be able to realize these tax benefits. Essentially, they have lost so much money that they have tax credits, but they do not expect to make enough profit in the future to use them before they expire. This section reiterates the various loans that we have already discussed, primarily from Mr. McCabe and Capco. It is worth noting the maturity dates for the notes from Mr. McCabe have been extended to the 31st of December 2025 with automatic renewal provisions. This suggests the company is in a perpetual cycle of extending its debt rather than paying it down. This note was paid in full in August 2025. This is a positive that they managed to pay off a debt. This relates to the costs of closing down oil and gas wells and restoring the land. The liability has increased from about $248,000 to over $1.1 million, indicating growing potential future cleanup costs. This is crucial for understanding what happened after the 30th of June 2025. They mentioned the Capco note was paid in full in August 2025. Good, then in August 2025, they got a new loan of $6 million from Panther Bridge LLC, managed by the CEO's son. This new loan has an 18% interest rate and comes with 3 million shares of preferred stock and a net profits interest in one of their prospects. The fact that they are taking on new debt at such a high interest rate and also giving away preferred stock and promising a share of future profits suggests they are desperate for cash. They also mentioned that the proceeds from this loan were used to participate in a drilling project that later turned out to be a dry hole in November 2025, meaning they spent money and got nothing from it. This is management talking directly to investors about what they think is going on. They reiterate their business model and projects. They mention a focus on acquiring early stage projects and developing them, monetizing them. It sounds like a common strategy in the oil and gas world. They discuss the volatile market conditions, inflation, rising interest rates, and geopolitical events. This is standard boilerplate for companies in this industry, but it does highlight the unstable environment they are operating in. They can't predict the future impact of these events, and neither can we. This section dives into the details of their revenue and expenses. The volumes sold are extremely low, only 99 barrels of oil equivalent for the quarter. This translated to tiny revenues of around $1963. This is not a functioning oil and gas production company in any meaningful sense. It's a company that seems to be barely producing anything. They show average commodity prices. For oil, it's around $71 per barrel. For gas, it's about $1.56 per thousand cubic feet. Gas prices at this level are incredibly low, which is likely why their gas revenues are so minimal. As we saw on the financial statements, these general and administrative costs are huge compared to their revenue and operations. This is a massive drain on their limited resources. This is all about cash. They are saying they need a lot of money to operate and they get it through borrowing. They acknowledge that their current cash on hand is very low, just over $4,600. They are heavily reliant on external funding and admit they might not have enough to meet their obligations for the year. Management believes they can get funding through equity or debt offerings, but there is no guarantee. This sentence is a bit of a punchline after all that discussion. They have just over $4,000 in the bank. That is almost nothing. This sums up the dire financial state: a massive working capital deficit, very low assets, and a huge hole in stockholders' equity. They are not in a good financial position. They state that their disclosure controls and procedures were not effective. This means they are admitting that they do not have good systems in place to ensure that important information is properly communicated to management and reported on time. This ties back to them being a smaller company, but it also suggests potential issues with transparency or accuracy in their reporting. This brings us back to the legal matters. The securities class action that was filed in New York has now transferred to Texas. While the district court dismissed it, the appeal is still pending. This means the legal cloud is still hanging over the company. These are certifications from their CEO and CFO confirming the accuracy of the report. It is a standard requirement. This is another certification required by Sarbanes-Oxley, often called the CEO-CFO certification for financial statements. Now, let's put on our investor hat and try to figure out what all this means. NextBridge Hydrocarbons Incorporated is in a very precarious financial situation. Their revenues are minuscule, their expenses are soaring, and they are losing money at an accelerating pace. The going concern warning is the loudest alarm bell here, telling us that their ability to keep the lights on is seriously in doubt. The company has massive debt, much of it owed to its own CEO, and a shocking lack of cash. Their oil and gas properties seem to have no proven reserves, which is the core asset you would expect in an oil and gas company. They are heavily reliant on new funding, and the high interest rates on recent borrowings, coupled with the failure of a recent drilling project, paints a picture of desperation rather than strategic growth. The company's direction seems to be one of survival, trying to secure financing and perhaps hoping to strike it rich with future exploration, but the current indicators are not promising. They are an emerging company, yes, but one that appears to be struggling immensely to find its footing. The combination of significant debt, operational losses, legal challenges, and an extremely low cash balance suggests a very high level of risk for any potential investor. It's hard to see a clear path to profitability with the current data. This is a company that is burning through money and has very little to show for it in terms of producing assets. The future seems heavily dependent on external financing, and the terms of that financing are becoming increasingly unfavorable. Alright, that is our breakdown of NextBridge Hydrocarbons' latest filing. What is your take on these numbers and what they signal for the company's future? Do you see potential or just a company struggling to stay afloat? Drop your thoughts in the comments below. If this analysis was valuable and helped you understand these financial documents, hitting that like button really helps us out, and make sure you subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community, the link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.